How strong is India's growth? Well, on the face of it, newspaper headlines will tell you it's great. The most recent GDP reading for Q2 FY24, that's July, August, September, was 7.6%, while markets were expecting it to be below 7%. In fact, the RBI's own official forecast was 6.5%, one of the fastest growing economies in the world. But before you feel pumped up and want to high five or slap someone in Josh, remember, when it comes to growth, what matters is not just how much of it there is, but also what's really driving it. And that's where the good, bad, and the ugly come out. Now, any economy in the world is made up of four things. On the demand side, consumption, which is what you and I buy from stores or order online, which is close to 60% of our GDP. Two, investments. Say when the government spends on building a road or when a company builds another factory, that's around 34 to 35% of the pie. Third, government spending on operational expenses like wages or government schemes. And fourth, net exports. So what you export minus what you import. This is the demand side of the economy. Another way to look at the same thing is on the supply side. So you simply add whatever activity has happened in that quarter on agriculture, on industry, and on services, which is also known as gross value added or GVA. So what's the story that's emerging? Well, let's talk of the good news first. There are three. First, India generally has been a country where growth lately has been driven by consumption. For a variety of reasons, our investment engine has largely been out of action. For a change, after a long time, investments are back at the forefront of driving growth. And much of this is happening because the government has been ramming down the accelerator on infrastructure spending, both at center and at states. You can see here how central government has budgeted a record high of 3.3% of GDP of investment spending in FY24. It's like one major push before general elections next year. When you combine this with the pickup in the real estate sector, it's not surprising that construction activity is growing strong. Second good news, the government is also spending a lot generally. So this is non-investment related spending, wages, subsidies, welfare schemes. And three, the industrial sector has done really well. Now you might be tempted to say, look, this is the government's Make in India at work. This is because of the production linked incentive scheme, PLI scheme, where the government is essentially subsidizing manufacturing firms to produce in India. Maybe. But the uncomfortable part of that theory is that foreign direct investment, so this is companies coming in and setting shop in India, those investments have slumped this year. So what could be the other explanation for strong industrial growth? Well, what many people don't realize is just as input costs for firms shot up after the pandemic, this year there's been a sharp fall. The manufacturing wholesale inflation, so this is broadly what firms pay for various goods, has come down from nearly 8% average in 2022 to minus 1% in 2023 so far. Fuel wholesale inflation has fallen from 34% in 2022 to minus 1% this year. And because input costs have fallen, firms' profits have picked up, even though corporate sales have struggled. And this is probably reflecting somewhat in the higher industrial growth. So that's the good part. What's going wrong? Well, three problems really. First, the obvious one. What happens when the government steps back from the pedal? Elections are coming up in a few months. The focus typically moves to things like freebies, schemes. Governments generally are not that keen to, say, start a highway project that will take years to come up when there's no guarantee if you'll still be in power or not after a few months. So once government spending comes down, particularly in the infrastructure sector, what will happen to growth? Two, and this is actually quite worrying, private consumption, which is close to 60% of our GDP, is slowing down. It was growing by a little over 6% in April, May, June, and it's down to around 3% in July, August, September. On the supply side too, we are seeing this for sectors like trade, hotel, transport, communication, which has a large share of unorganized workers. We're also seeing this in the financial, real estate, and professional services. These sectors have seen weaker growth rates this quarter vis-a-vis last quarter. And look, we've done a couple of episodes of The Bond Economist on this. One on the cracks in India's consumption story. The other one on the alarming rise of personal loans in India. Please do check it out. Now, you may still say, what slowdown? I went to a mall last week, or boarded a flight yesterday, or went to a restaurant today. All of them were chock-block full. So what might be happening is that one end of the consumer spectrum seems to be driving consumption in India. The better off people in urban areas who weren't affected much by the pandemic were getting regular salary hikes, relatively more resilient to higher inflation. They are spending like crazy on premium cars, phones, vacations, houses. But what the GDP numbers are essentially telling you is that the other end of the spectrum, poorer people, the rural side of the economy, is not happy at all. Which brings me to issue number 3. Agriculture growth has slumped to 1.2% from an average of 4.6% in the past 3 quarters. And this is not surprising because we've had really erratic monsoons this year between June and September. And the first advanced estimates of Kharif or summer crops production suggest that it's going to slump this year. Cereals, pulses, sugarcane are all looking to be less than last year's levels of production. Food inflation is actually pretty high in India currently, and we have flagged this in another previous episode of The Bond Economist, where we sort of laid out that agriculture production, whenever that suffers, so does the rural economy. And we are seeing the first of those signs in the latest GDP numbers. So let's take a step back and figure out what the story is on the official GDP statistics. By the way, these are not my flights of fantasy. This is just me reading the data. And that reading is telling that India's growth is certainly strong, but a lot seems to be driven by the government, be it in the form of government pouring in money in infrastructure or general public spending picking up. This, along with the real estate recovery, is showing up in stronger consumption growth. Corporate India has also benefited a lot from a sharp fall in input costs that have helped it increase profits. But the biggest worry is that India's consumption engine is slowing down. Its domestic services growth is slowing down, which suggests that people may be struggling, particularly the unorganized sector, particularly the rural economy, particularly the poorer population. So if you felt like high-fiving someone at 7.6% growth, well, for now, maybe keep your hands in your pockets. For more such insights, like, share, and subscribe to The Bond Economist.